Last week, we talked about paid up additions inside of whole life insurance policies. This week, it's all about the dividends. Welcome to the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
Appreciate you guys joining us. Let's hop into dividends without delay. Carlo, at the base level, what is a dividend?
So a dividend is something that a company pays out to its owners. It is sort of a return of earnings that the company has done well, and they're going to return some of those earnings to the owners of the company.
And generally, in a whole life insurance policy owners, they might become part owners of the company, in which case they get to participate in the profitability of that company and earn dividends. And in other whole life companies, they might not be mutual companies that pay out a dividend based on the profit, but they might still pay out what they may determine is a dividend. Now, mostly in this space, high cash value life insurance, we're focusing on mutually owned companies. Why is that?
Well, in mutual companies, the policyholders of the whole life policies are actually the owners of the company. And that's really key because you're not splitting those earnings with other people. As policyholders, the bigger the policy that you have with that company, the more ownership you have in that company, and the higher the dividend is that is paid.
Yeah, and a lot of the big mutual companies have been around forever. And because the policy owners are part owners, they're generally treated better than they would be in any other company, than they would be with any other insurance carrier. So we've got strong financials, and we have that trust that you just get from being an owner of the largest financial companies out there that happen to have the safest products as well. Now, when it comes to dividends, there are a bunch of different things that you can do with your dividend. What's the default version?
I think, is it?
Yeah. What's the default way that dividends get treated? If we'll probably see 99% of policies set up this way.
So the default is with paid up additions, and it's pretty much 99% of the time what we would recommend doing is to do those paid up additions, which is kind of short for paid up additional insurance, which in turn is additional death benefit that you have prepaid. It's paid off, you own it, and that will continue to earn. That will also have a cash value represented in today's value of that future death benefit.
That's right. Now, before we hop into all the other things that you can do with a dividend, I want to back up just a little bit because I think it's important to get this out of the way right at the beginning, because a lot of people notice that a lot of insurance companies will announce a dividend rate, and then they look at their policy and they didn't get that dividend rate. They don't see that amount credited in their annual statement. What's going on with that?
So the dividend rate that insurance companies announce is what's called the gross dividend rate. And that is prior to expenses being pulled out. So that's why you'll see a slight difference between that gross dividend rate and the actual crediting rate against your own policy's cash value.
That is usually the biggest difference that people will see. But there's another thing that people will notice. When you get your annual statement and you see the dividend, that number is even smaller than that. And the reason for that is because you have a guaranteed growth amount that's considered separate from the dividend. And that guaranteed growth amount might get credited throughout the year, but then on your annual statement, you're going to get the dividend that's above and beyond that. So when it comes to a whole life payout, you're guaranteed to get the minimum guaranteed amount according to your contract. But then if that amount is higher than the guaranteed amount, there's a surplus on that dividend. And that is what gets displayed as a dividend payout on your annual statement. Now, there might be some companies that treat this differently. This is most of the companies that I'm aware of, and all of the annual statements that I've seen. We'll see that number listed, and it's definitely not going to match the announced dividend rate that companies love to tell the world that they're paying out. And it's important to understand why that is.
Yes, and so one thing that I misunderstood initially when hearing about this is that guaranteed rate, and in my head, somehow something landed that the announced dividend rates were in addition to that. That is not the case. That dividend rate is the gross dividend. The difference between the guaranteed rate and the gross dividend is that surplus dividend. So it's just important to understand that, but what gets paid out is that total dividend.
Very important to understand that, because there are some people out there, slick salespeople, engaging in puffery and maybe trying to scam people, that love to say that they're getting the dividend rate and the guaranteed rate. And that is definitely not the case. Okay, so let's shift back. What else can we do with that dividend? You mentioned we can use it to buy paid up additions. That is generally the default setting. There's a few other things that we can do.
So we can choose to have it paid out as cash. And some people might do this at various points, and especially maybe once they're done funding. There's different reasons why you might do this. But generally speaking, it's in my preference, we don't want to do that early on in the policy. We want to have that policy continue to grow. So that's why it's not my preference to have that paid out as cash.
Yeah, so if you get it paid out as cash, it's going to first pay back what you've paid into the policy. We call that the basis. And you're able to get those dividends tax-free. Once you've recouped all the money you've paid in as premium, then it's going to start getting taxed as income. So it's not very advantageous tax-wise to continue getting those dividends paid out as cash. The other thing to consider there, when you do put it back in as paid up additions, you're not just getting that back into the policy there, but it allows that compounding year after year. Whereas if you're just taking that cash, it's going to be the same amount that gets paid out each year, because presumably your policy is maintaining instead of growing and compounding. So something to be aware of when you think about, what do you want this policy to do in the future and what do you need it to do right now? What's another choice?
So the next one kind of connects to that. I wouldn't tend to see any reason for this, but you can choose to have the dividend paid into a different interest-bearing account that is not part of the whole life policy. So I don't really see a purpose to this. I'm not really one to want to use this. So it is an option that can be done with some policies.
Yeah, I'm not familiar, or at least I should say I've never come across a scenario where I've found it advantageous to use this option, where you're just going to set it into an interest-bearing account. It's not buying paid-up additions, so you're not getting the benefit of additional death benefit. Your death benefit when you get a paid-up addition is a multiple of the dollar amount. That money's just going to sit there in cash earning interest, and it's going to get taxed. So I'm not sure what the point of that is, but it is an option. Okay, and what's the other option?
So another option is premium offset. So you can have the dividend reduce the amount of premium that you need to pay. And again, not really my preference. There could be times, though, where you might have an emergency where you don't feel like you can make that premium payment. So having the dividend offset that premium can be an option if you need to.
Yeah, this one is kind of important to understand that it's available. In whole life insurance, you always have to make a payment each year toward that base amount of the policy. It's required. And if you don't make that payment, your policy can lapse, even if the policy has a lot of cash value inside of it. So if you're not able to make a payment, there's two things we like to look at. One, we want to have an automatic premium loan set up. That will just borrow from the cash value. It doesn't require you to change what's going on with your dividends. You can just keep them getting paid up additions, and that will turn into cash value. And it'll just borrow from the cash value to pay that base premium. But the alternative option, if you know that you're done funding the policy, you're going to want to request an in-force illustration from your agent and take a look at the other two options that you have with regard to stopping funding the policy. Those are turning it into a reduced paid up policy, where the death benefit is going to get reduced to an amount that's considered paid up, and no more premiums can go into the policy. You're not going to contribute any more money to it, but it will still continue to grow, kick off dividends, buy more paid up additions. So the cash value and the death benefit will continue to grow. And you can still use that policy just like your infinite bank, just like a line of credit. The other alternative is to do the premium offset. I have ran some illustrations where when there's a lot of money inside the policy, it can actually be more beneficial to the client to take some of that dividend and maintain that minimum base premium payment of the whole life portion of a policy instead of turning it off and doing the reduced paid up. Doesn't happen very often. I will generally look at it. That's why I say you got to talk to your agent and look at the different options when you know you're done funding the policy. But that can be a good alternative to just doing a reduced paid up.
Yeah, that one that you just described is a little bit counterintuitive because I've run illustrations that demonstrated that as well. You would think that by reducing the death benefit and having the credit be buying paid up additions over time, it somehow will outperform. But there are some circumstances that having that premium offset will perform doing that reduced paid up. So it is weird.
I think it's generally the case when we have a company that treats the base amount different than paid up additions. And if you keep maintaining paying that base, you're going to get a higher participation rate when they figure on those dividend payouts. So kind of complicated, and life insurance companies or the whole life policies are not required to reveal how they distribute that dividend or how the expenses are figured inside of your policy. You just get to see the amount that the policy goes up in cash value each year. So it's really hard to pull back the curtain on that portion when they just don't reveal what's going on in there. But from running a whole bunch of illustrations, we kind of get a picture of how these things get treated. And that's generally the case if it's a company that treats the base differently and we've built up a substantial amount of cash value. You definitely have to have the substantial amount of cash value for that to work. I've never seen it work with low cash value. I don't remember if we talked about this with the paid up additions last week, but part of what the dividends do in the designs that we like to do that are optimized for high cash value is those dividends are going to pay for part of the supplemental term insurance that we've built into the policy in order to reduce the overall expenses. And then whatever's left over after it pays for that term is going to end up buying those paid up additions.
Yes, and it is that blend that really allows for us to put a lot of money into these policies and optimize that to get those high percentages of cash value in those early years.
Yeah, it's kind of funny. We were listening to some other folks, different podcasts, talk about all the different things that can happen with dividends, and they happen to mention that they rarely see it, but sometimes the dividend will buy that supplemental term and then go to buy the additional paid up additions. And we kind of got a chuckle because that's like the backbone of an optimized high cash value design. We should see that in almost every situation. Not every situation, but almost every situation. An optimized design is going to have a setup that has some blended supplemental term insurance with it. It could be level term, could be annual renewable, but that blended design is key, and how the dividend interacts with that is important.
Yeah, and I think that's really the main thing is that there's a lot of different people in this space. Not everybody knows about all of the different things and the different carriers. And I think that we have, in my mind, whenever I've seen any other content out there, we're making some of the best optimized designs with, in my mind, the best carriers. So I think that it's important to look around and see some numbers. James has got some great illustrations on his channel. I've got some on my channel where we do some comparisons of these less optimized ones. So when you look at the numbers, these optimized designs are going to tend to be the best for you, the client, and make sure you're talking to somebody who is doing the policies like that.
Good points. Now back to the dividends. When it comes to the announced dividend rates, I think it's important to know that just because they see a big number out there, the biggest numbers aren't necessarily the best. Why would that be?
Some carriers, I think, just do a better job of managing those internal expenses in order to get the crediting much closer to that gross dividend rate. So I think that's a key factor in some of the great performing policies, like my own policy. It is actually not the highest gross dividend, but in my mind, it's probably the best in terms of actual crediting rates, at least right now.
Yeah, that gross dividend rate can be treated differently among the different policies for each carrier. So when we see a dividend rate announced, that doesn't mean you're getting that particular amount credited to your account. Now, the other thing to consider, insurance companies can announce any dividend rate they want. You could have a company announce a 14% dividend rate, but then if they decide that their expenses are 12%, your net amount is going to be a 2% credit. Whereas you could have a company announce a 5% dividend rate and maybe they have a 1% expense and you get a 4% credit. Now, I don't see the 14% scenario ever happen. I've never seen that happen where they're announcing 14%, but they're charging 12%. I'm just saying it could happen, and we have to be aware that some of these things do happen inside of policies because they're not required to disclose the expenses. So when we run our illustrations, it gives us a window into how much they're charging for the insurance internally. We want to look at the internal rate of return from the designs to get an understanding of what is my expense ratio going to be throughout the life of this policy. There are some really bad policies out there that you might get an internal rate of return that's less than 3% over the course of 30, 40, 50 years. That's generally not good, especially if that carrier also announces high dividend rates. They've got really high expenses. Now, it's possible they just don't make very much money and you're not participating in very much. And so that internal rate of return is just not going to be good. But a lot of our top carriers have 6% and 6% plus for an announced dividend rate. But the higher the number doesn't necessarily translate into the higher cash value and the higher internal rate of returns when we're funding the policies the same way. Kind of boils down to, one, that internal expense, but then also we've got to look at how they treat a base policy that might have a blended design with it. Are they going to treat it differently, and does it impact that growth negatively? Just because it does doesn't mean that's a bad design. You've got to run the numbers and see where does it end up at the end of the day. There are a lot of folks out there that would have you think that just because a carrier treats a base policy differently and they're going to pay out less of a dividend on the paid up additions amount, that you should have an all base policy. Well, it just so happens that all base policy pays out the biggest commissions. And because of that, you have no cash value growing for the first couple of years, and it starts to slowly grow. So even though the dividend amount is going to be a higher percentage on that base amount, it grows in actual cash value so slowly, it will never catch up to an optimized design that is built up of mostly paid up additions, even if that paid up additions is getting a slightly lower treatment from that dividend.
And I think that's really a good reason to try to get an in-force and save the file maybe once a year or every couple of years so you can kind of keep track of things and keep an eye on that internal rate of return. I'm confident that the carriers that we choose and the designs that we do, they're going to be strong. But if you're not happy with it, or if maybe you have a poor design, you want to have one of us take a look at it, we could review things, see how things have done over time, and then in the end, if you are not happy and you want to 1035 it to a different carrier, that's transfer it basically to a different policy with a different carrier, then you have that option. And if you're not paying attention to it at all, then you may go a really long time and realize that you haven't had great growth in poorly designed policy that you may have been sold at one point.
All right, I think we've about covered it. We talked about dividends, all the different things that you can do with it, how it can be treated when the company pays out the dividend. We talked about what to look for when it comes to dividend announcements. And we talked about how to check your illustrations and use those for helping to determine how it gets treated among different carriers. Now, you can shortcut a lot of this information by just having a conversation with a knowledgeable insurance agent. Not every agent does the deep dives that you see from us here, where we can bring you detailed information. So it's important that when you're talking to agents, try and figure out if they do actually understand what's going on. It can be complicated stuff. With that said, do you have a call to action for our listeners this week?
It's time for this week's call to action.
I'd say check out some content that is on my channel, James's channel, and maybe a couple other creators that compares some of these designs. And when you can actually see some illustrations compared with these carriers and with these whole life carriers, then that may help you to decide which route you want to go. And, if it makes sense, book a meeting with us so we can review maybe illustrations that you've got from elsewhere, and we'd love to work with you.
Now, to be clear, Carlo is referring to our YouTube channels. He just says channels, but he means YouTube channels because you get the visuals. We're putting up the numbers and you can actually see them. It doesn't work out very good to go over a bunch of numbers on a podcast that's just audio. So definitely check out our YouTube channels. A lot of good information to come across there. And it's definitely eye-opening when you get to see the actual numbers and what it does when we get an optimized design. Next week, we're going to be talking all the different flavors of whole life insurance that are available out there. And I think we're also going to tack on how to look for an optimized design. So we're going to talk optimized designs next week as well. Be sure to join us for that. I appreciate you. And definitely reach out to us if you have any questions, concerns, comments, or you want more information. My name is James Barber. I'm your Oregon Cash Flow Pro, and you can find me on YouTube. We sell life insurance and annuities across the country.
And my name is Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.